A trade war that is underway between the United States and China. Yes, we are learning that U.S. officials privately behind the scenes urged China to not retaliate.
And will China hit back at Trump's tariffs by pulling, as what one guest in the morning told us, the nuclear option? That is, selling U.S. Treasuries, U.S. bonds basically.
If China wants to crash the United States economy right now, all it has to do is simply sell all the U.S. Treasury bonds it is holding. What would follow would be an economic disaster like never seen before. China holds approximately $760 billion in U.S. Treasury securities, positioning it as the second largest foreign holder of U.S. government debt, following Japan, which holds about $1 trillion. Here is the thing. If China dumps all $760 billion bonds it holds, other countries will follow, and instantly, the United States would have trillions of debt it has to pay to China and those who sell off. Unimaginable. Trump and China are locked in an intense standoff, each side raising tariffs in a tit-for-tat escalation. But as the pressure mounts, China might resort to a drastic move, dumping its U.S. Treasury holdings. The big question is, will China actually go that far? In this video, we'll break down the facts, analyze the risks, and show you exactly what's at stake, and why the consequences could shake the global economy. Make sure to hit that subscribe button. And let's dive in. Xi Jinping, faced with an aggressive American tariff regime and rapidly deteriorating diplomatic ties, has appeared calm, almost calculated, in his response. Many in Washington attribute this to political posturing or nationalism, but a more subtle and chilling possibility exists. Xi knows he holds a financial lever so powerful that it could destabilize the U.S. economy with a single strategic pull. That lever is China's massive stockpile of U.S. Treasuries, currently estimated at over $760 billion. And history shows this wasn't accumulated by accident. So, how did China become America's banker? It began in the late 1990s and early 2000s, when China rose as the world's factory floor, flooding U.S. markets with toys, clothes, electronics, and furniture. In return, American consumers sent hundreds of billions of dollars to China. But instead of letting that cash sit idle, Beijing recycled it, mostly into U.S. Treasury bonds, effectively lending that money back to the American government. Why? The reasons were strategic. Buying U.S. Treasuries helped keep the yuan weak, making Chinese exports more competitive. It also provided China with a safe, liquid place to store its foreign currency reserves. And most importantly, it deepened economic interdependence between the two powers, creating mutual incentives to avoid open conflict. Over time, this strategy turned China into one of America's biggest creditors. By 2013, Beijing held over $1.3 trillion in U.S. debt. That number has declined, but China remains a major player in the bond market, second only to Japan. And while the holdings have shrunk, their geopolitical leverage has grown amid rising tensions. The U.S. government runs massive budget deficits year after year. In 2024 alone, the federal deficit reached over $2 trillion, driven by military spending, entitlement programs, and mounting interest payments. To fill this gap, the Treasury issues billions in debt every week, much of it bought by foreign governments and global investors seeking safe returns. Xi Jinping may be thinking exactly that. Why match tariffs tit for tat when he holds a more devastating option? Dumping treasuries? And this moment is uniquely dangerous. Multiple crisis points are converging. The U.S. heads into a volatile election year, with Trump's return sparking aggressive tariff hikes. Meanwhile, China is under pressure over Taiwan, U.S. tech sanctions, and tightening American alliances in Asia. In past disputes, Beijing showed patience. But in 2025, the stakes are higher than ever. National survival, technological sovereignty, and economic independence are on the line. And that makes the temptation to strike back, financially, stronger than ever. The very act of China unloading large volumes of U.S. bonds would unleash a cascade of consequences. First, the bond market would be flooded with excess supply, driving prices down and yields up. This would immediately raise borrowing costs for the US government, intensifying its already ballooning deficit. As interest payments rise, Washington would need to borrow even more just to cover the cost of past borrowing, risking a dangerous debt spiral. But the impact wouldn't stop there. Rising yields would ripple through the broader economy, pushing up mortgage rates, auto loans, student debt, and credit card interest for millions of Americans. Second, such a move would erode global confidence in the US dollar. The dollar hasn't dominated global trade simply because of US economic strength. It's also about trust. If the world's second largest holder of American debt signals that it no longer sees the US as a stable debtor, others might follow. A Chinese sell-off could trigger a chain reaction among other major holders like Japan, the UK, and Saudi Arabia. Third, the reputation of US Treasuries as the world's safest asset would be shaken. These bonds are foundational to global finance, used as collateral in trillions of dollars worth of transactions. If their value becomes unpredictable, the stability of the entire financial system could be called into question. Skeptics argue that China would never go this far. It would hurt itself, too. That's partly true. Selling off treasuries would lower their value, costing China money. It could also strengthen the yuan, making Chinese exports less competitive abroad. But the political pressure on Xi Jinping is rising fast. The US is cutting off China's access to critical technology, piling on tariffs, and strengthening military ties across Asia. In this context, economic pain may be acceptable if it serves a larger strategic goal. The trade war of 2025 is no longer just about economics. It's now a struggle over global power, national pride, and freedom from US dominance. And Xi may decide that short-term losses are a price worth paying to weaken America's financial empire. China doesn't need to dump all its treasuries at once to cause disruption. Even quietly reducing purchases or shifting reserves into alternative assets can send powerful signals. And that's already underway. Over the past few years, China has steadily trimmed its US Treasury holdings while ramping up purchases of gold, expanding currency swap agreements with countries like Russia, Brazil, and Saudi Arabia, and promoting the digital yuan for cross-border trade. These aren't isolated moves. They're part of a broader plan to reduce dependence on the US dollar. In 2024 alone, China slashed its treasury holdings by nearly $60 billion, falling from $818 billion in January to $759 billion by December. The most dramatic drop came in February, when it offloaded $22.7 billion in a single month, citing concerns over the Federal Reserve's tightening cycle and the broader impact of US policy decisions. By year's end, December marked the 9th consecutive month of reductions, including a $10 billion cut from November. Analysts see this as a calculated strategy: diversify reserves, reduce exposure to US debt, and bolster financial security through assets like gold. China's steady retreat from treasuries signals more than a policy tweak. It marks a potential turning point in global finance. And others are paying attention. Around the world, central banks are quietly following suit. The share of global reserves held in US dollars has dropped below 59%, its lowest level in decades. Many countries are diversifying into gold, euros, and even China's currency. If Beijing takes bolder steps, it could trigger a broader exodus from the dollar-based system. But how did things get so out of control? The answer lies in how Donald Trump, the United States president, has decided to relate with foreign countries. In April 2025, the world economy was shaken when the United States, led by Donald Trump, took a bold and risky step. Trump announced a 34% tax on all goods coming from China. This was added to an earlier 20% tax, making the total tariff 54%. This meant that Chinese products became more than half as expensive as they were before. This tax increase affected almost everything: electronics, clothes, machinery, and even everyday items. American families, already struggling with high living costs, now faced even higher prices. Businesses had to deal with smaller profits, delayed shipments, and confusion about what would come next. This was not a negotiation tactic. It was a full-blown escalation. China responded with a mirror action, a 34% tariff on all U.S. goods. But then came retaliatory tariffs on top of retaliatory tariffs. So far, China has raised its tariffs to 125%, while the U.S. has stopped at 145% on Chinese products. That means an item that used to cost $100 now costs around $250. Purely because of increased taxes. This triggered panic in the financial markets. The stock market dropped sharply. The Dow Jones Industrial Average fell more than 1,200 points on the day of the announcement. The Nasdaq, which has many technology companies that depend on Chinese parts, had its worst day since the early days of the COVID-19 pandemic. Investors rushed to move their money into safer places like gold and U.S. government bonds. While Trump was increasing pressure on China, something unusual began to happen in Chinese state media. Government news channels started talking about something they called Liberation Day. Although they did not fully explain what it meant, the message was clear. China wants to free itself from its economic dependence on the United States. This could involve many serious moves, such as selling U.S. bonds, using less U.S. dollars in trade, and removing American companies from the Chinese market. China is already taking steps in this direction. It has started increasing trade with countries like Russia, Saudi Arabia, Iran, Brazil, and others, using its own digital currency, the digital yuan, instead of the US dollar. China's central bank has signed deals with Russia's and Saudi Arabia's central banks to use the digital yuan for buying and selling oil and other products. This is a direct challenge to the US dollar, which has been the main currency used in global trade for decades. Inside China, the government is asking its companies to stop depending on American technology. They are trying to develop their own computer chips, airplane companies, and banking systems. The Chinese government has even banned some American technology products from being used in state-run projects. This effort to reduce dependence on the US is now moving faster than ever before. China is also in talks with the BRICS group to create a new international currency. This currency might be backed by gold or other natural resources. If this happens, it could seriously weaken the US dollar's importance in the global economy. The most worrying possibility is that China could do all of these things at once: sell off US bonds, stop using the dollar, and remove American companies from its markets. That would be a serious economic attack. Organizations like the IMF and World Bank might not be able to stop the damage if it reaches that level. What started as a trade dispute could turn into a massive shift in how the world economy works. The growing fight between the US and China is not just their problem. It affects the entire world. One of the biggest risks is what happens to the US dollar. Right now, about 88% of all global trade is done using dollars. If China starts selling its US government bonds, it could cause the value of the dollar to fall sharply. If the dollar falls, the price of borrowing money in the US will rise. That will hurt American businesses and consumers. But the pain will not stop there. Many developing countries borrow money in US dollars to build roads, power stations, schools, and hospitals. If the dollar becomes unstable or interest rates rise quickly, those countries might not be able to repay their loans. The oil market could also be thrown into chaos. Oil is mostly priced in dollars. If the value of the dollar swings wildly, oil prices could become unpredictable. That would increase transportation and energy costs everywhere. This is the end of an era, and it is just starting. The question now is, can the world survive a financial system without the US dollar at the center? If you're watching this, you're already ahead of the curve. But what's coming next could shake the global economy to its core. So, subscribe now to stay informed, because the next move might change everything.